March 2020. Market liquidity is evaporating at an unprecedented velocity. The Federal Reserve faces a sovereign debt implosion that threatens the fundamental stability of the global fiat system. Rather than relying exclusively on the internal bureaucratic apparatus of the United States Treasury, regulators pick up the phone and route their emergency directives to a highly fortified private server farm in Wenatchee, Washington. Here sits an algorithmic entity executing a staggering $21 trillion in daily risk management protocols. This isn't a shadow bank. It is the central nervous system of global capital. It is called Aladdin, the asset, liability, debt, and derivative investment network. While retail investors obsess over ticker tape fluctuations and consumer-grade algorithmic trading bots, this monolithic computational architecture quietly dictates the capital allocation parameters for sovereign wealth funds, national pensions, and the corporate treasuries of mega-cap tech conglomerates. The terrifying reality is not just its sheer computational magnitude, but the fact that the state apparatus effectively outsourced its emergency monetary policy execution to a proprietary neural network owned by a single private corporation, blurring the line between state power and corporate algorithmic supremacy. We are witnessing an era where financial hegemony is no longer defined by physical gold reserves or traditional geopolitical maneuvering, but by localized computational superiority and asymmetric data aggregation. Aladdin processes trillions of discrete financial permutations every millisecond, running hyper-complex Monte Carlo simulations that predict exactly how a sudden geopolitical skirmish in the South China Sea will impact the yield curve of municipal bonds in Ohio. This absolute monopoly on financial truth creates an unprecedented paradox: a supposedly decentralized free market where the vast majority of institutional capital acts upon the exact same risk topography generated by a singular technological oracle. When a single terminal dictates the macroeconomic reality for over 10% of the planet's total financial assets, it creates a systemic choke point so profound that regulatory bodies lack the technical vocabulary to even audit it. Today, we are tearing down the firewall of the most secretive and consequential technological monolith in modern economic history, exploring how the localized trauma of a single Wall Street trader birthed an omnipresent computational sovereign that fundamentally owns the blueprint of the entire global economy. To decode the architectural DNA of this monolithic risk engine, we must reverse engineer its inception back to a catastrophic miscalculation in 1986. Larry Fink, then a superstar bond trader at First Boston, pioneered the securitization of mortgages, generating unprecedented alpha for his trading desk. However, his reliance on fragmented siloed data streams led to a devastating analytical blind spot regarding interest rate volatility, resulting in a sudden catastrophic hemorrhage of $100 million in a single financial quarter. Fink was unceremoniously ousted, but this deeply public humiliation catalyzed a profound operational paradigm shift. He realized that the fundamental architecture of Wall Street was fatally flawed. Institutions were managing multi-billion-dollar asset pools without a centralized, unified ledger of quantitative risk exposure. When Fink co-founded BlackRock in 1988 under the Blackstone umbrella, the prevailing institutional thesis was simple: aggressive asset accumulation. Fink, however, engineered a contrarian operational chassis. BlackRock was never designed to be an asset manager in the traditional sense. It was engineered from day one as a supreme technology infrastructure firm that happened to manage capital as a proof of concept. The financial products were merely the Trojan horse necessary to feed raw, asymmetrical market data into their burgeoning computational model. In its nascent stages, Aladdin was essentially a glorified proprietary risk calculator, a closed-loop internal mechanism designed solely to ensure BlackRock never repeated the first Boston structural catastrophe. It mapped complex derivatives against infinite macroeconomic vectors, utilizing stochastic calculus to price collateralized debt obligations with a quantitative fidelity previously deemed impossible. While legacy banking titans relied on subjective macroeconomic forecasting and qualitative intuition, Fink's syndicate weaponized deterministic quantitative modeling. They built a continuous feedback loop where every executed trade refined the algorithm's predictive resolution. By the early 1990s, the system's analytical architecture had become so brutally efficient at stress testing idiosyncratic market scenarios that corporate entities began begging for access to its raw computational output. General Electric was among the first outside conglomerates to mandate its own liquidation strategies be routed through BlackRock's terminal to navigate volatile corporate paper markets. This marked the absolute genesis of a profound structural inversion. The moment a proprietary internal safeguard began mutating into the centralized nervous system for external institutional capital, turning an internal auditing tool into the ultimate financial panopticon that would eventually monitor the circulatory system of the planetary economy. The operational mechanics of Aladdin are staggering, operating on a computational scale that eclipses the GDP of several sovereign nations combined. To understand its asymmetric structural leverage, we must examine the specific telemetry of its underlying architecture. Currently, Aladdin monitors over $21 trillion in assets under management across its closed network, analyzing roughly 2,000 distinct risk factors for every single security mapped within its database. It executes billions of sophisticated Monte Carlo simulations every week, stress testing global portfolios against bespoke macroeconomic catastrophes, from a sudden 50 basis point rate hike by the European Central Bank to a localized supply chain rupture in semiconductor manufacturing in Taiwan. The physical infrastructure underpinning this digital leviathan relies on server clusters stationed globally, processing upwards of 250,000 trades daily. This isn't merely passive portfolio management. It is a hyperactive, dynamic risk-sculpting protocol. It integrates structured and unstructured data sets, pulling localized geopolitical risk assessments, satellite imagery of retail parking lots, and hyper-frequency maritime shipping logs. By continuously cross-referencing these granular inputs against historical crash paradigms, the system provides institutional asset managers with an actionable, deterministic probability matrix, effectively stripping the emotional friction out of high-stakes capital allocation. However, this unprecedented aggregation of intelligence introduces a deeply unsettling systemic vulnerability meticulously obscured by corporate public relations machinations. The dark reality of Aladdin is the artificial homogenization of global institutional risk mitigation. When over 200 major institutional clients, including direct corporate rivals, state-sponsored pension funds, and insurance leviathans like Prudential, all plug their proprietary ledgers into the exact same algorithmic matrix, they surrender their analytical autonomy. BlackRock charges these entities staggering licensing fees, driving roughly $1.5 billion in high-margin technology revenue annually, while simultaneously absorbing their localized trade flows into Aladdin's central neural net. This creates a parasitic data loop. The algorithm becomes smarter by actively ingesting the proprietary strategies of BlackRock's competitors. Consequently, if Aladdin's underlying mathematical assumptions regarding specific collateralized lending structures are fundamentally flawed, the resulting contagion won't be isolated to a single firm. Because the majority of the market's liquidity providers are reacting to the exact same algorithmic dashboard, A singular miscalculation could trigger a synchronized, high-frequency mass liquidation event, transforming a theoretically robust risk management shield into a localized weapon of mass financial destruction. Regulators remain completely paralyzed by this structural reality. The true asymmetry of Aladdin's business model is found in its precise semantic IDs and deep technological execution protocols. Utilizing FIX, Financial Information Exchange, protocols and rigorous API integrations, it offers a total end-to-end processing pipeline, from the initial portfolio construction and pre-trade compliance checks to post-trade settlement and custodial reconciliation. By embedding itself directly into the actual plumbing of back-office operations, Aladdin achieves an impenetrable zero-churn paradigm. Once an institution migrates its multi-billion-dollar ledgers onto BlackRock's proprietary operating system, the switching costs become mathematically prohibitive and logistically catastrophic. Furthermore, through the strategic acquisition of eFront in 2019 for $1.3 billion, Aladdin seamlessly integrated alternative asset classes, private equity, real estate, and unlisted debt, creating a unified risk vernacular across both public and private markets. This total market visibility grants BlackRock an unassailable informational arbitrage advantage, allowing its internal strategists to map macro trends and capital flight vectors months before they manifest on the balance sheets of traditional macroeconomic forecasters. They are not merely participating in the financial ecosystem. They are actively hosting the very server upon which the financial ecosystem operates, extracting a perpetual toll from global capital. The definitive strategic pivot that catapulted BlackRock from an elite asset manager to an invincible systemic techno-monopoly occurred when leadership decided to unbundle Aladdin and aggressively weaponize it as a commercial enterprise solution, known as Aladdin Provider. This was a masterclass in asymmetrical ecosystem building. Instead of hoarding their supreme technological advantage to generate isolated proprietary alpha, they flipped the paradigm, licensing the terminal directly to their fiercest competitors, including Vanguard and State Street. By doing so, BlackRock completely altered the battlefield geography of global finance. They recognized that owning the underlying infrastructure of the market was infinitely more lucrative and geopolitically powerful than simply fighting for basis points on retail index fund expense ratios. This strategic shift transformed former adversaries into deeply dependent technological tenants. It mirrors the exact playbook Amazon Web Services used to dominate the Internet infrastructure space, but applied to the far more lucrative realm of sovereign and institutional capital. By establishing this ubiquitous standard, BlackRock effectively mandated that any institution wishing to interface with modern capital markets must speak the proprietary dialect engineered by Aladdin, subjugating the entire industry to their architectural specifications. This structural hegemony crystallized unequivocally during the macroeconomic seizures of the 2008 Lehman collapse and subsequently the 2020 pandemic lockdowns. In both instances of extreme liquidity evaporation, the traditional bureaucratic apparatus of the United States Treasury and the Federal Reserve proved entirely inadequate to map the complex toxicity of collapsing mortgage-backed securities and frozen corporate paper. They were forced to enlist BlackRock's Financial Markets Advisory Unit, directly utilizing Aladdin to orchestrate multi-billion-dollar bailout mechanisms and stabilize failing asset classes. This represents the ultimate systemic shift, a private corporate algorithm dictating the execution of sovereign state survival tactics. By successfully navigating these sovereign bailouts, BlackRock cemented Aladdin's reputation not just as a commercial product, but as critical national security infrastructure. It erased the boundary between public policy and private enterprise, securing BlackRock's position as a permanent, indispensable fixture in the geopolitical landscape, immune to traditional antitrust legislation. This unparalleled regulatory capture, achieved not through conventional lobbying, but through sheer computational indispensability, demonstrates the highest evolution of corporate strategy, creating a system so fundamentally intertwined with the survival of the state that the state itself becomes its primary guarantor. The saga of Aladdin fundamentally rewrites the accepted principles of modern capital accumulation and institutional leverage. The ultimate business lesson here is that true, unassailable power is no longer derived from capturing market share within an existing ecosystem. It is achieved by physically building the infrastructure that hosts the ecosystem itself. BlackRock didn't just want to win the game of finance. They engineered the proprietary table, the chips, and the mathematical laws of probability governing every single hand played by their competitors. For the premium strategist, the imperative is clear. You must pivot from operating as a localized participant to positioning your enterprise as the absolute systemic necessity within your specific vertical. You must engineer structural lock-in, where your analytical output becomes the definitive source of truth for your entire industry, effectively turning competitors into dependent nodes within your proprietary network. The future belongs exclusively to those who control the architectural flow of information and risk, transforming internal algorithmic safeguards into ubiquitous industry standards. If you want to dissect the invisible frameworks that dictate the movements of elite capital and master the blueprints of systemic monopolies, subscribe to Capital DNA. We do not chase market noise. We decode the source code of absolute financial hegemony. Join our syndicate of forward-thinking architects and ensure your strategic paradigm is anchored in the uncompromising reality of data-driven dominance. The next iteration of global wealth transfer is already being calculated. Make sure you understand the algorithm dictating its trajectory.